with nuclear weapons on the table for decades. This is always the case, that we're living on the edge of something horrific happening.
But these are kind of the advanced things. The easy stuff is just buy great quality companies and hold them for a long time.
With the advent of stablecoins, in the bill, companies and small little entities could issue their own stablecoins. For example, Amazon might have its own coin.
Now we have a new version of money which has advantages over what we used to think of as money.
The fact there's a car driving itself right now is insane.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hello and welcome to the latest Wall Street Wildlife with Christoph and Luke. On this week's episode, Robotaxi is finally rolled out in Austin. Our man is not there to witness it on the ground, but we are looking avidly at what's happening in the world through the lens of various YouTube influencers riding around in your home city. Stablecoins are in the news. Christoph is going to break down what stablecoins are and tell us specifically about the impact on credit card companies and traditional finance. We're also going on safari with a semiconductor stock that isn't NVIDIA.
Indeed, Badger. So the return of the native sun continues with my second week on my home soil. Anyone watching on YouTube could see my uncle is doing his best to try to remind me of my roots. And being here in Poland, war is never far away from one's mind. So it was a little bit ironic isn't the word, but just a couple of days ago, we woke up to some potentially scary headlines with, at least in the New York Times, United States enters war or declares war on Iran. I forgot what the official headline was. No, they didn't declare war on Iran. They just bombed the nuclear sites. But the headline was big and scary is the point.
Yeah, if you look at Trump's tweets, right? Like, you bombed the hell out of Iran's alleged nuclear facilities and then say, now is time for peace. So clearly.
Yeah. As we were chit-chatting before rolling the cameras, it's a difficult position to find oneself as a human because we're reminded on one hand of the atrocities of war because it's just not a good thing to bomb and blow stuff up. And on the other hand, it seems like no matter where we go and no matter what era of humanity we're in, war is just something we do. And I think one takeaway is from what you and I said briefly is that we are not experts in the historical sense, in the geographical sense, in the geopolitical sense. And there's a lot of pretend experts out there who will tell you what to do, how to move your money, because this, that, and the other thing. And we're not going to do that.
Yeah. And it's sort of trivial maybe to take just a really horrible time in history, which seems to be getting worse and worse. We almost, there's so many different geopolitical conflicts. And then that one just to escalate just in the last 48 hours, like we're recording on Monday, the 23rd of June. And it's to trivialize it, perhaps, to then just start talking about impact on financial markets. This could escalate, become very, very serious, and there could be significant loss of life. Who knows where we're going to go. And, we're recording on the 23rd. We're currently 8 days prior to our publication date. This will go out early July. The world is probably going to change materially over the next 7 or 8 days. So just seems daft to try and make any predictions.
Yeah, and I suppose from my end, it's also a reminder that with nuclear weapons on the table, as they have been for now decades, this is, I suppose, always the case, that we're living sort of on the edge of something really horrific happening. So, I don't have anything intelligent to say other than maybe in terms of investing. Besides having some wise ability to predict where oil prices might go, but even that's incredibly complex, my take now is to do nothing and not try to market time and flee to safety or all this because it's too complex.
Pretty much. It is somewhat surprising that markets haven't like reacted violently to the news from Saturday. Things seem to be pretty stable. I guess oil prices fluctuated quite a bit, but then they kind of stabilized. Equity markets haven't really moved. I mean, maybe everyone's just focused more on like inflation and domestic financial situation more so than what the US is doing overseas. But yeah, I don't know why I don't know why markets are not in turmoil today.
Yeah, the volatility index is actually quite stable. It's at 20, which
Yeah,
is a relatively where it was
yeah.
before. It could be.
I read
Yeah,
a
here.
I read a humorous Reddit post where someone said, "I'm convinced the market is one of two things: A, manipulated beyond human understanding, or B, the market has figured out how to price in pure absolute chaos, which is quite a feat."
That would be quite the feat. My take on that is that market is mostly narrative driven. It's like
Yeah.
the stories we tell ourselves as human beings, and right now it's a story of war, and we think this is going to happen and that's going to happen, but we don't know. But we do know that right before market open today, to get into stock stuff, this is one of your Safari stocks, HIMSS.
I think it was one of yours. My Safari stock was Novo Nordisk, which I did buy, and I own that now. And I know that's been in the news, but I've been at a piano lesson for the last hour and a half. So what's happened?
Well, you schooled Wall Street wildlifers on HIMSS at one point, saying that it's mostly like a platform, a healthcare platform. At one point, the
Okay.
news this morning was just that Novo basically rescinded their collaboration with HIMSS and making their Ozempic-like drug no longer available. I think there's some other potential like legal worries or whether HIMSS somehow broke the law with like a knockoff to the drug or something like that, which I do not know anything about really. But I do have this to say. This is exactly one of the reasons that, if you remember what I was saying about Oscar Health from the other week, stuff having to do with healthcare regulatory uh, machinations behind the boardroom movements. I think unless you're really an expert in that domain, there's just no way of knowing something like this can happen. I mean, it's just not foretold in any way. And this is, I believe, if this comes to fruition and holds somehow, that this really problematizes the entire HIMSS thesis because it was such a major source of revenue. So my TLDR is I'm not touching this kind of healthcare stock for exactly this reason. You just don't know when you're going to wake up to this kind of news. It's not good.
Yeah, like I'm not anti hymns, but there is like that sort of teledoc potential to it, where there's quite a lot of hype. Essentially, they're sort of a distributor of drugs, or drugs that were patented by other organizations. And what was it they've? I'm not a HIMSS expert, but it's like erectile dysfunction, hair loss, and weight loss, and maybe there's some other stuff. But that was like the pillars of their revenue, and I think it always seemed a bit dubious to me, like the sort of basis of personalizing or customizing, essentially like remixing these patented drugs and then selling them. And these are quite serious in some. Well, certainly the weight loss one is like, you shouldn't be able to buy it across the counter. I think you do need like a doctor's approval in the UK to get it. I don't know what the status is in the US, and maybe like HIMSS are doing a bit of an end run around that by having virtual MDs that would like have a relationship with you and prescribe it. Are they really prescribing it based on what little they know about you? I don't know. Like, I'm not against these drugs. I think they are going to revolutionize the world. I've got a couple of friends who are taking like Wegovy and Ozempic, and it's like helping them. But still, this stuff should be used with some element of medical supervision, I think.
I agree. It's just I'm looking at the stock price right now. It's 27 down 27%. My point is it's down 27% on the decision that another company made. on its behalf. So how much control did HIMSS itself have over its fate? And in this moment, it looks like not as much as investors had hoped or implied or assumed. And so it's the same point I'm making about Oscar, because Oscar is actually going the other way, since I kind of said be cautious about it. But again, that point is that it's in the Trump administration's hands. So I don't know about you. I don't like necessarily investing in stuff where it feels like whichever way the wind might blow is the way your company's going to go, and they don't have anything to say about it, either due to complexity or regulations or the industry it's in or government interference or whatever. So
yeah, that's fair. That's fair. Yeah, you want to own companies that are in charge of their own destiny to the extent that they can be.
Yeah, to the extent that they can be. In health, I would argue healthcare is like rule number one of you're not in charge of your own destiny unless and you're actually the one discovering the drug, which is why I have the my investments in biotech, because that process cool. you're
all right. Well, like breaking news, I guess. Watch this space. We'll see how it plays out. I'm pretty happy as a Novo Nordisk shareholder. This probably plays into Novo's hands if HIMSS is down, that's probably beneficial for them because they're going to do more market capture alongside Eli Lilly, who actually manufacture the competing drug.
Yeah, that for now, that seems like a good bet you've made. You know what? Some more general idea I came across. It was making its round on the internet. I'm not sure if you came across it. Roger Federer gave a commencement speech. I believe it was last year, or Dartmouth. Did you come across this? No, this is fascinating. So, one of the greatest athletes and tennis players of all time, Roger Federer, gave a speech, and this particular speech appears like to be one of these like ones that are going to stand the test of time. In that speech, he dropped a quote. He asked the graduates how many points in terms of percentage do they think he won in his tennis career. You have a guess?
Well, more than half, I guess. Otherwise, you wouldn't have been world champion. I know, like 70%.
Yeah, that's a sensible answer, right? If you've won all these Grand Slams and you've dominated for 20 years, right, you must have won some larger amount of points. But he said he only won 54% of his points.
Yeah, fair enough.
And I thought that's a pretty useful thing for us to think about just a little bit, because it gives me similar feelings about investing, because we know we're not going to be right. When we know not only are we not going to be right, it's impossible to be right all the time, and we're going to be wrong, and feeling wrong feels bad because we lose money when we are, and that for many people scares them off. But that would be the equivalent of saying, like Roger Federer saying, I'm not going to play tennis anymore because I'm the world's best and I could barely win, literally barely win more statistically, I win as much as I lose. That's his point. So where's his edge come from? How do you only win 54% and yet be one of the world's best? And I think if you dig deeper there, that's where there is an edge to be had, where in a sense you win the points that really matter, is one way of saying it, or you make the kinds of investments that really matter, or you take advantage of setups that are really in your favor, which is done through due diligence and time and a kind of prolonged period of honing your skill set and so forth. But it certainly is not about quantity. And that's actually, now that I'm rambling and running my mouth, it does go back to the point I was talking about last episode, I think, or 2 episodes ago, where I felt, or maybe it was just on our Patreon, where I was looking at my King of the Jungle portfolio, and I was really pleased at only having 12 positions. Like, it just felt kind of good, like, oh yeah. And I think it's something to this point, right? Like that 12 feels manageable. Therefore, I could keep my eye on the ball, so to speak, with only 12 positions, so to speak. So that confidence kind of grows, and I can make more aggressive bets, and the bets that I win matter more. So even if, you know what I'm saying? I don't know how that resonates with you.
No, it totally does. Like, and like if we think about that Federer percentage, like he can be the world champion and he can only win like just a tiny fraction more than half of his points, and that's still enough. And as you say, like it's the ones he wins are important. As an investor, like you can get way less than half of your decisions right, and you can still be a successful investor because of the asymmetry. Like when you get an investment decision wrong, you might lose 20-30%. Like in like a Teladoc case, you might lose like 90%, but they're pretty rare, to be honest. And it's very rare that something literally goes to zero. Does happen. But when you get it right, often it's like a 200%, like 100% gain. You've 2x'd or you've 3x'd. And I've got a couple of like 50 times returns. I've got a 250 times return in my investing career. So that 250 times return, I can only have to get one decision right out of 250 if you look at it that way, like way less than like a 0.4% of a whatever, 0.25% of my decisions I have to get right. Obviously that's extreme. You're not going to run into many 100 baggers plus, but if you're lucky as an investor, you might have a handful in a lifetime. And that allows you to make a lot of bad, in retrospect, bad decisions that didn't play out well because the few that you got right really won the game for you.
I think this is a bigger point than I originally anticipated. I kind of just wanted to add, drop a cool kind of fact with you tied into investing, but we know that. So when I listen to normal people, meaning like normal people, most people who aren't investing in individual stocks, almost all of them, at least extraordinarily high percentage, say something to the effect of, it's a game I can't win. You can't possibly get everything right. It's this point that they kind of miss. And I think this is why Federer was hymning it to the grad, saying it's not about being right, not even most of the time. You just barely, you have to just break even, but the quality of of the things that matter have to be on point. And that's a huge insight.
And there's a whole host of other reasons why people, play the stock market and then figure it's rigged and they can't win. Like I'm using deliberately like loaded language there, because of all the other disciplines they get wrong. A stock is up, a position's up like 20 or 30%, and they're like, oh, I got to lock in the gain, protect. It's like I'm playing with house money. These are all completely flawed concepts, right? If you just keep it real simple, does the thing I own, do I understand why I own it? And B, do I continue to believe that thing is true? If A and B, then just continue to own it. And at some point, portfolio management kicks in and you need to like manage your exposure to one particular like possible risk. But these are kind of the advanced things. The easy stuff is just buy great quality companies and hold them for a long time.
Amen. Speaking of great quality companies, I'm looking at price movement this morning, and our good old standby Tesla is up 6% this morning. Meanwhile, I'm not in my hometown to witness the Robotaxi launch, but you did a little poking around about some of the mechanics and tech behind what's going on. What do you have for us?
Yeah, I posted what turned out to be a slightly controversial. It's very rare I get any engagement on LinkedIn, but I do just publish everything to Threads, LinkedIn, and Twitter. And usually you have a really good conversation on Twitter, and it's just thin as F. Nothing on Threads because I've got hardly any followers there, and LinkedIn is just people celebrating each other and BS, and there's no quality. But I did. So what I posted was somewhat controversial, and it was an article I read a few days ago that comparing Tesla's approach of vision only, which is like a bunch of cameras on the car, to Waymo's approach of having a whole host of sensors, but specifically LIDAR. So if you don't know really what LIDAR is, LIDAR stands for light detection and ranging. It's a bit, I imagine it like radar, right? And some cars have radar as well. Tesla's used to, but they took the radar off because they're trying to cut costs. LIDAR is just, you see these cars with like the Waymo with the big like blob on the top. It's shooting lasers out that you can't see. They're not going to hurt your eyes, but they're basically scanning the environment, and it gives it like very, very precise kind of depth perception. Can see how far things are away, because we can tell how far things are away because we've got two eyes. If you're not vision impaired, and your brain does some processing, you're like, oh, this thing is close and this thing is further away. So you can do like range detection. It's complicated algorithms with a bunch of cameras on a car, which is what they do. But LIDAR is much more precise, like down to the millimeter. How far away is that thing? How fast is it moving? And also, like lasers kind of bounce around objects to some extent. So you can also, you can sort of, a bit like radar, you can kind of see you can see through things in certain circumstances. And then with some very fancy algorithms, basically LIDAR adds, it's less brittle than vision only. Like you have more data that you can make, like every microsecond, you can make your self-driving decisions around and hopefully make better decisions. Like more information, in theory, you should be able to make better quality decisions, which should eventually equate to like safer, smoother rides.
Now, this would not be
Tesla.
Oh, so this would not be. It sounds like good tech, like we want to be as safe as possible. But years ago, Elon went on the record many times saying this is not the right technology to back, and he was unequivocal about this. So was he wrong?
No, he was right at the time, because like his position has always been LIDAR is really expensive. So like back when he was making that decision in the 2010s, it was like $70,000 to $80,000 to equip one vehicle with LIDAR, really expensive. And that totally blows the economics that he had in mind of mass market $30,000 cars. Like you can't do that if one part of the car is like 70 grand. So he took the company very firmly down a vision only path, but things have changed. This is a point I was trying to make on LinkedIn. I'm not sure it was landing with the people I'm trying to debate with, because they're all just attacking me and saying, oh, you're just like a Tesla non-believer. The world has changed, and Musk, we laugh about whether he's being overly optimistic, but he'd always positioned FSD, full self-driving, as being like a couple of quarters away, 6 months away, a year away. And so then if LIDAR costs you like $70,000, and if you think you're going to have FSD working in like 12 months time, like LIDAR is not going to come down that much in 12 months, but it didn't happen that quick. Like in the end, it took years, 5-10 years, and maybe now they have FSD. Arguably, we can debate that in a second. And over those 5 or 10 years, apparently, I don't know the details, the cost of LIDAR has come down substantially. And so I found like a Chinese article, or an article from a Chinese news source, referring to Li Autos, who have now adopted LIDAR into their cheapest range of cars. They quoted as saying a LIDAR unit used to cost 30,000 yuan, about $4,000. Now it's less than $138. So if you need like a couple of LIDAR units on a car, I think like a Waymo has like 4 or 5. Like you're talking about potentially ballpark of $1,000 to outfit a car with LIDAR, compared to $70,000 decades ago. So the world, that has changed materially. And I wonder if Tesla should be revisiting this.
Yeah, it's a good question. The only pushback I saw was that we have to be careful in adding another layer of complexity. And I'm not expert enough in the field to know what happens when you, I guess, cross two modalities, so to speak. More equipment, more stuff, or just more inputs. And I still tend to trust Elon. I don't know if this is me being naive. I tend to trust him as a kind of science mind. So when he says that it's not needed, then if it's just a cost issue, then is this really end up becoming a kind of split in the way, just, I don't know, like two modes of doing the same thing, and one is not necessarily better than the other. You just have two types? And if so, is that like a death knell for one or the other, or is this? It doesn't. Let me rephrase all that. This doesn't seem necessarily like a problem for Tesla as much as it's encouraging for the competitors.
Yeah, like what it comes down to, like, it's an interesting time to have this conversation because yesterday Robotaxi went live. And so arguably they have now, if you really sort of buy into the hype, they have now proven that vision only works. Now, okay, it's the first couple of weeks, first 2 days currently. They've only got 35 taxis, robotaxis on the road in a geo-fenced area, a particular part of Austin. And they've got a safety driver, or, someone like, I don't know, a volunteer or a Tesla, employee sat in the passenger seat with their hand on like the stop button where they can just kind of, if things go wrong, and then the passengers in the back seat are, they're just regular people, albeit they've signed up and they've signed all the waivers and disclaimers about being like a beta passenger in this new service. If Tesla can legitimately scale this and eventually take the safety driver out, and then eventually, because also they've admitted, they'd be foolish not to, that they have like remote oversight, like teleoperation. I'd like to credit Pasha at Seven Investing with sending this one to me. It's pretty hilarious. Like if you're on the YouTubes, it's kind of a meme. AI, an Indian, API, a person in India, LLM, low-cost labor in Mumbai, AGI, a genius Indian, right? So the joke there being that most of these companies, when they say they got AI, what they've got is like an army of people offshore, like pretending to be AI. But it is a sensible first step. Like if you're rolling out a remote, like a robo-taxi operation, you'd be nuts to not have someone somewhere in the world, doesn't necessarily mean India, like monitoring this thing in real time, certainly for your first couple of 100,000 hours. And then eventually, maybe you have a smaller number of people monitoring a bigger fleet of cars, and they only intervene when the car kind of flashes and said, oh, complicated situation. And then eventually maybe there's nobody at some point. So sensible steps, but we're in that early stage, right? We're in 48 hours into Tesla Robotaxi. And the question is, can they ever, with vision only, can they get beyond these like human safety net versions to like a true nobody monitoring it? It's just doing its thing and racking up millions and millions of miles.
Can we get just a little perspective on this, Badger? I mean, my God, just the bare fact that there's a car that's sort of driving itself right now is insane. That is a technological accomplishment that, I don't know, 20 years ago, like, was as science fiction as anything else. And then, my very minimal understanding too is that the scaling of this, like the more of these there are, the easier it's going to be to control because more data. And now you're driving with other robots that are more predictable, and it just kind of the problem kind of gets easier and easier, so to speak. So exactly as you said, the fact that there's still a big red button guy sitting in the passenger seat during like day 3, for all the cynics and all the complainers, I'm like, what? I mean, my God, like, chill. Like, let's see where we are a year from now. Okay. If we're still in the same exact kind of predicament, then sure. And yes, there's Elon's over exaggerated timeframes and, but hey, progress is progress. To me, this is an extraordinarily good thing for humanity long term. So
yeah, like I'm down with the trajectory, and I own Tesla and I own Alphabet. Like I think all of the acclaim you've just dished out there, that belongs to Waymo because they have actually done it using vision and LIDAR and whatever other techniques. And now Tesla, like in some ways they've handcuffed one of their hands behind their back by going vision only. And if they can make it work, that's going to prove beyond a doubt that this was the right approach, because they'll be able to deliver cars at a lower cost point, even though that cost might be marginal. Like $1,000 per car, that still adds up. Like that's material. But the question is, can they get beyond Like, can they get to the point they've taken the human driver out and they've taken away the remote monitoring? Because Waymo have done that. And can they really deliver outside of their geo-fenced area? Because that was like the original sales pitch. Your car can operate anywhere, do anything. They haven't proven that. And, maybe there is what the path they've chosen, maybe it cannot scale beyond a certain point. So that's that's the main question I was raising. And hopefully, and I'd say this tongue in cheek, hopefully Elon can put his ego aside and say, yeah, the cost of these raw materials has changed for safety, to protect the city of Austin and the people, when your wife's out shopping, to protect her from being mown down by like an errant Model 3, we're going to stick some LIDARs on this car because they only cost like $1,000. Hopefully, if that proves to be necessary, he'll take that decision as opposed to like out there murdering your friends and neighbors.
Right. I always thought Elon, when it comes to topics about technology, is forthcoming in terms of like what the better thing is. I'd be very curious to hear on the next earnings call whether there's any mention of exactly this, and some analysts should ask about exactly this question, cost cutting and stuff. There is the fact of how ugly the thing is, though, and with it looks. Yeah, it just doesn't look. It looks like a whole nother contraption. But when you were talking about it's only $1,000, but then there's going to be the upkeep and repair of the stuff and things getting broken. So probably the cost is still a big factor. But let's see how this shakes out.
The LinkedIn conversation did go there this morning, right? Someone said, "Oh, it's only $1,000." Like, you idiot! $1,000 really adds up. It's really serious. A million cars, that's like $1 billion. Well, let's not forget. And again, I'm a Tesla fan. Not sure I'm a Musk fan, I'm a Tesla fan. Let's not forget about the Volkswagen Dieselgate scandal, 10 years ago. And that ended up costing the company apparently $33.3 billion US once everything was accounted for and all the recalls and the fines and the class action lawsuits. And this could amount to the same thing because you could allege, if they're kind of suppressing failures and faking data and trying to make it look vision only, look better than it really is, kind of amounts to the same thing. You're rolling out like harmful technology and then trying to cover it up. I don't think we're going to end up there, but I'm just saying there is like, even if you take out the human cost, there is like a economic cost to Tesla if they persist with vision only, and they could have maybe delivered a better outcome with vision plus LIDAR.
Right. So to be determined. But I'm surprised that the Tesla stock is up 7% today. That's I did not see that.
Yeah, that's cool. That's cool. I think there's always going to come, right? Like they've hit the date, which is a good thing. I will admit that I was skeptical about whether they would hit the June Austin Robotaxi date, and they have. So I guess the stock deserves to go up for that, if only. It's whether they can get beyond into like actual unmonitored self-driving.
Are you willing to risk Monkey's life for the show's benefit? You want me to hop into one of those things when I get back to Austin?
Like, I'm literally outraged that you've left Austin just as it rolls out. Was it to protect you and your family?
I was hoping you would say, no, my dear Monkey, protect yourself. It's too early. Your health above all.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
Well, you've prioritized a different kind of vehicle, though, right? What is it you're cruising around in Poland?
I believe it's a 1973 manual Jaguar. My uncle's.
What's Jag?
Excellent. Yes. Well, that's why I sent it to you, because your people
Yeah.
Your people are behind that one. Yeah, it's quite a ride. It's sweet. But boy, do you feel every millimeter of on the 50 years of engineering has gone a long way. But yeah, no, it's really sweet to drive. Only 4 gears too. Speaking of rides, the image of the Trojan horse entering the gates of Troy with the it's a meme, and the Trojan horse is labeled Stablecoins, and inside the Trojan horse is a smaller army of smart contracts. And so I'd like to explain, Badger, a little bit about what's going on with stablecoins, because it's kind of a topic du jour. So uh, quite recently, the Genius Act was passed in the Senate. It's going for a vote in the House, and it's expected to pass and be signed into law. The Genius Act stands for Generating Efficient National Innovation and Utility for Stablecoins Act. So let's get the basics out of the way. This is stable coins are kind of like digital money that live on blockchains. So instead of a paper dollar, you have a digital dollar, and they're backed by actual assets, so dollars or treasuries, and that's what makes them effective. And they're pegged to the dollar, so it's a one-on-one. So why is this a big deal? Well, because the analogy I thought of, Badger, is that every so often there is a big paradigm shift in how things are done, and then even when it's sort of out in the open and we know things are heading that way, it really does disrupt the previous generation's technology. And I'm thinking of Kodak and digital film. So, photos used to be done sort of made manually, processed with a film, so longer, slower. But then digital cameras come out, and now why would you work with film anymore, really? I mean, other than for like vintage purposes, right? But it's just such an obvious progression. And so Kodak as a company, was worth a lot, and then not so much, not much later. The question now is that for payment companies like Visa, MasterCard, American Express, they're sort of like the middlemen that call it facilitate payments across the world. But if you think about it, they take a cut, often in businesses that have low margins. So it's not when you go to the supermarket and you use your credit card, you're actually, you're slicing off what's already very thin margins. So that's, for some businesses, it's a big deal. It takes time, to settle the transactions. They're only open, they're linked to banks, so it's not like they're open all the time. Your credit card payment doesn't work on Saturday, Sunday. There's all this stuff, right? And obviously you can't program any of this. Versus stablecoin, just flip everything I said to the positive. There's basically tiny transaction costs. They're mostly immediate. It's global. It's 24/7. And based on this meme we just showed, they're linked to blockchain, which means you could basically, on top of your payment, program stuff that you want to happen to the payment, with the payment, after the payment is done. This is where, that's that beginning portal into the idea that you might in the future buy a house that's digitized, because you could program a bunch of stuff into the contract and all of that. So the real question of the day is like, should MasterCard and Visa and American Express be worried, given that this bill is passing? So for now, let me say that the big innovation, so to speak, of the bill is not really much of an innovation besides saying, look, this is a thing. The government is actually in its favor. They're saying it's not going to compete with the dollar, but actually kind of stabilize the dollar. And this stuff is going to be transparent and backed by what blockchain is good for is going to be transparent and audited all the time. So they're basically trying to get the stench of the crypto casino away from the space. So you might be sitting there, Badger, listening to me yap and still say, well, okay, fine, but my credit card works just fine. I'm not the small business. Like, I get what I need, right? I pay off my credit card. Like, why would I ever do something like this? And I think the other point is that at the moment, these digital coins or stable coins do give a better yield. So it's almost like you own your own. I mean, it's like having a better savings account. That's one main point. Side note, this is exactly Circle Internet Group, which is a recent IPO. This stock is now up massively over the last couple of days to like a crazy $50 billion valuation. Basically, it's like they run the stablecoin USDC, and like a bank, they collect money for kind of holding on to it. They collect interest, which they also pay out to those who use USDC. So it's kind of like a better dollar, is the TLDR, right? But okay, so what? Well, I think this is where you get into the innovation stuff, that with these digital coins, if they really do what they say, which is remain steady, transparent, it's not a scheme, they give you a little bit of yield, well, then you get to play around with network effects. And if you remember our conversation about blockchain and how I wanted us to reframe what blockchain really is, that's really a decentralized computer on which things run that enable networks that are owned by everybody rather than like one mean, evil corporate entity. Well, with the advent of these kind of stable coins, in the bill, we saw that individual, call it companies and small little entities could issue their own stable coins. So like, for example, Amazon might have its own coin. Now, this is just the very beginning of stuff, but where my mind goes is when you cut out more of the middleman taking their fees and you get to transact with your own coin, then your own little network basically gets to keep more of its money. And if you get to keep more of its money and everything else functions as it should, then you get to have more of your money and then reinvest it. And it's a kind of virtual cycle. So I'll land the plane here by saying there's a lot of cynics out there for good reason, because entrenched technologies are entrenched for a reason. Visa, MasterCard are great businesses. They know this is a thing that's coming their pike. And yet, somehow humans continue to make things better. We continue to evolve. And this seems to me like it has the promise of really making the entire financial industry even better for the users. How it's going to shake out, really, I don't know. If I were a Visa or MasterCard or American Express shareholder, would I buy, sell, or hold? I really can't say. It would surprise me if somehow these big behemoths were not actively thinking of their own version of these things to participate in it. I don't think it's like a dinosaur existential event for them at this moment. But like Kodak, to go back to that analogy, it's here one moment and then dead the next. So it's certainly a fascinating space to watch. And I'll end by saying my investment in Chainlink kind of is agnostic in all this, because Chainlink basically makes sure that the protocol on which all of this stuff runs is secure, and basically the tech underlying it is stable. So it's going to benefit from all of these things without needing to pick any horse.
Yeah, good breakdown. Thanks for educating us all. That's useful.
And so check out CRCL. That's the ticker for basically, it's the new company just IPO that's kind of backing a lot of the tech and the capital to make their coin be one of the dominant coins at the moment. I would not invest in this at the moment, because there's a lot of the hype bubbly stuff happening with the passage of this bill.
I guess if you wanted to invest in this, you're suggesting perhaps buying the company Circle, because if you buy the tokens, well, they're just dollars, right? Because they're pegged to the dollar. So you might as well just have dollars in your bank account.
Right. Why would I invest in something like Circle? I think it's the same thinking of why people invested in MasterCard and Visa and made tremendous profits over a long period of time. If this is in fact a paradigm shift and it works, then a company like Circle is going to make a lot of money just because of the massive scale. I mean, it's like, it'll run the entire world's financial industry. But I think that's a long ways away. And at this moment, I think, in that curve of enthusiasm, we're at that rocket stage where people are just all hyped up that the bill actually passed and that the US government isn't just shooting all this down. But my best guess is that it's going to come back down to earth before kind of settling into a more reasonable valuation down the road. It's just an exciting time for finance in general, seeing what blockchain enabled stuff can do. It really does open up a lot of doors.
Yeah, but it also opens up a bunch of additional risks as well, right? Like educate me if I'm wrong, but the same old rule of not your keys, not your crypto would apply to stablecoins as well, USDC. So like if you have real physical dollars, like you've got the money, sure, you could get like robbed, like the house could get broken into, you get mugged in the street, you've lost your dollars. In the same way, if you lose your cryptocurrency, you've lost your cryptocurrency. But maybe it's, maybe most people won't hold, because if we talk about this from, let's say, the consumer perspective, right? Most people won't hold their own keys because it's a risk and it's complicated. So you rely on institutions. And if you want to, let's say if you're some mastermind criminal organization, maybe like a state-funded terrorist organization, and you want to bring down like the system, if you want to rob like Fort Knox, there's like a lot of physical stuff you have to do. It's not out of the question. I guess it could be done, but pretty complicated. And if you want to like steal trillions of dollars of treasury bills, though, I mean, I don't know, maybe it's not possible to do that. But if you wanted to steal, well, let's say billions of dollars of stable coins, well, it only requires like, one human break in the chain of like custody over, say, Amazon's own repository of keys. And they could potentially, a company like Amazon is going to take this stuff so seriously and be so careful. But I think the point I'm trying to make is if you have like a failure in the existing legacy banking system, like you can reverse that with legislation. You could say, okay, we know these dollars have been stolen. Anybody who presents like this, bearer bond, we know they've been stolen, and maybe there's some ways of intercepting and intervening. Once you've lost the keys to your crypto, like it's mathematically impossible to recover from that. And certainly there have been like Bitcoin heists in the past where like the FBI have been monitoring certain Bitcoin wallets for years, waiting for the perpetrators to make a mistake. And that's how that like American couple went down and ended up in jail, that crazy like girl.
Yeah, small nuance. The not your keys, not your crypto thing, that's true in the spirit of Bitcoin, because the whole point of that is you're your own sovereign and you're outside the government's jurisdiction and you're taking responsibility to be your own bank. But that means, if something goes wrong, you're out of luck, buddy. But the irony in some of the stablecoin stuff is that basically to guarantee this stuff and to bring people on board, it's going to be adopted by like major platforms, like, for example, Coinbase. And one of the points of this Genius Act is stablecoin holders receive priority repayment in the event of issuer bankruptcy or probably some other malfeasance. So the irony of that is the original crypto point was you get to do things yourself, but now you're relying on centralized platforms, which basically help onboard you and keep you safe. So it's a little bit of a, I don't know, chicken and egg, or, are we back to where we started? And I think my answer to that is in some ways, yes, but in some ways, no. Like cable, people cut cable cords, but they started watching individual shows, but it still feels different than it did before, even though maybe you're not paying any less, but it's still a different world out there. So Who knows where this is going to ultimately lead, but the potential for the way finance runs is massively now in the game. And let me make this practical for you, or as practical for our listeners as possible. Keeping, let's say, $10,000 in your checking account for just just life expenses is a reasonable thing for me to say is like most people should have that. It's just money easily accessible. But now I'm thinking, why keep $10,000 in checking that is, let's say, just sitting there and losing value in terms of inflation? Why not, let's say, keep my checking account to say something like $3,000 for like literal debits here and there, and take $7,000 into one of these stable coins that has a yield of, let's say, 4 or 5%. And the more merchants that begin taking this stuff, it's going to, like Shopify, Amazon, all these things are on the way. Now I kind of have like a checking / savings account all in one, and my money's not losing value. And that's how I might actually begin playing with it. And if the number that I came up with is too much, just take off a zero, right? Start with $1,000 and do 300 and 700 or something like that. But I would encourage people to start poking around and start doing this. And that's how network effects get off the ground anyway.
Yeah, fair enough. I'm going to take the opportunity to plug one of my favorite companies, though, Wise, because Wise, they're not a bank, but there's like an account product with different currencies. You can hold your currency in, and you get like 4% interest, or they can invest it for you. Like there's different ways of having like the interest product or the investment product. And so, you kind of get the same thing. So you don't have to own stable coins to get 4% on your money, and you can still be highly liquid. I'm not arguing with your sort of thesis here around this, right? It's good. And like anything, if it truly removes friction and reduces costs in the financial system, it's a good innovation. And maybe there's some additional risks and they have to be managed in certain ways. But that's an innovation. Whether like American Express and Visa and MasterCard, maybe they can adapt to it in some way. Like these are like historic, massive companies that presumably have seen this stuff coming and they have a plan for it. I don't know what it is. So I wouldn't want to make any forecasts about kind of who's going to win, or even if someone has to win. But now we have like a new version of money, which certainly has some advantages over what we used to think of as money.
Right. And also remember, Larry Fink and BlackRock, they're all in on digitized real world assets being tokenized, like everything going on chain eventually. So this is to remind everyone, if stable coins work, then this is just the beginning of that next evolution of finance. So that's where the real money is going to be.
All right, good stuff. Interesting. Good. Well, let us know if you do buy some USDC yourself at some point.
Yeah, I'll
or circle.
Yeah, I'll keep you all up to date. That's a good reminder. I should kind of play around with that a little bit.
Great stuff. All right. Would you want to round us out today by taking us on safari with a semiconductor company that is not NVIDIA?
Yes, sir. So this is a company that I briefly held in King of the Jungle, AMD. And I've been poking around quite a bit, reading this, that, and other thing. And they recently had an investor presentation. And I'm finally coming around again to saying this is a company I'm probably going to add to my King of the Jungle portfolio again at a higher price. And this is what convinced me, Badger. Very briefly, AMD has always been sort of like the second best. But at first they were second best to Intel. And then eventually they outcompeted Intel by just getting better and cheaper and faster. So they took market share, right? But then along came NVIDIA, and NVIDIA ate their lunch. And I still maintain this motto, why invest in second best? But as we talked about ad nauseum on this show, AI is kind of a two-part thing. First, you have to train the models, then you have to use the models. And to train the models requires massive, massive amounts of compute and GPUs. And that is NVIDIA's obvious $1 trillion bread and butter. And ain't no way AMD is catching up to them. That ship has sailed, as far as I could tell. But with the new chips, which have staggeringly unnecessarily complex jargonistic names like the it always tickles me because the 300X 500i, like whatever, I don't care. It seems to me from everything I've read that the real game in town regarding AI now is the whole inference stuff, which is basically using the models. And to use the models, they have to be very, very quick, very, very responsive, which requires a lot of memory and a lot of speed. And it turns out that is AMD's, that those kinds of chips is where AMD is just as good at, if not even a little bit better than NVIDIA. So where the puck is going now, clearly, once all the models have been trained, or no one's competing with NVIDIA on them again, then it's like now using these things, and AMD is clearly a horse in this race, as we know from being backed by Meta and Microsoft, to name just two. So I'm looking at this and saying, the second place horse, valuation wise, is nowhere near NVIDIA's lead, but they don't need to be. All they need to do is perform very well and kind of outcompete in terms of making things cheaper and faster, which is something they've always been able to do. So I'm getting quite bullish. I'm getting quite bullish on AMD, and in my own King of the Jungle portfolio, I have two positions so far that are directly AI positions, and I like this idea of a basket. So I'm thinking this is a good moment for to add AMD, sort of relatively early in the curve about regarding what's coming next. So I'm excited. Looking to make this move soon.
All right, good stuff. Let us know when you do. We're all familiar with AMD. Like, it's a name that's been banging around the industry for many years, and its CEO is like the second cousin of Jensen Huang, CEO of NVIDIA. And they've always, in recent years, they've played second fiddle. But if they now have a domain where you think that they can really prosper, then it does become interesting.
Yeah, maybe a summary point of everything I said is bigger is not always better, or like more powerful is not always better. And it seems like AI has enough nuance now for this really, really excellent company. AMD is just an excellent company all around. It's just that it paled in NVIDIA's shadow because its time was not yet up. And now it seems like it's ready to take the stage, and there will be two. It's not like NVIDIA is still going to dominate, and it seems like AMD has a shot at dominating this second market, the second phase, rather.
Yeah, like you don't have to be like the best company to succeed. Like there's a lot priced into NVIDIA's valuation. Like, I haven't run the numbers in the last couple of months, but actually I think NVIDIA's valuation is quite reasonable at the moment. But there have been points in history when it's been, objectively overvalued, but they've grown into it. Like they've delivered beyond all expectations. You can be the second biggest, you can be the third biggest, you can be like the 20th player in a market if the financials make sense. Like if you're like the ROI as an investment and the risk and the return balance, like you can still make a ton of cash and perhaps even do better on smaller companies that maybe are going to grow faster and disrupt like the giants. Even if they don't disrupt the giants, they can still carve out like a really healthy return for shareholders.
And one additional note, actually, to put NVIDIA in context with AMD, one of the big mistakes I think we both made regarding NVIDIA was selling a little too early because of that, when it got, we thought overvalued, but also just gigantic. I think when they crossed the $1 trillion mark or whatever it was, right? Now they're at $3 trillion, and there's plenty of smart people out there saying, well, the world's going to run on AI, so it's going to 10 trillion, right? Like, we're in unprecedented waters. in terms of how big, call it the next industrial revolution squared, will be. Well, AMD right now, Badger, is only, in quotes, 212 billion. So sure, that's huge, but if the whole world is going to be running on this thing, a 5x gets it to 1 trillion, and Inference is going to be running everything. So it no longer seems preposterous to me that going from 200 billion to 1 trillion is like, oh my God, that's too big. Where my gain's going to come from? It actually seems relatively like reasonable, or I'm not being like pie in the sky, and I'm not being pessimistic. It just seems like, yeah, I could see that in 5 years, 10 years, whatever. Those will be great gains from here. So
yeah, good. Right, and I hope that plays out for them. That'd be great. It's always good to have like multiple players. You don't want any market dominated by one. Yeah. All right, good stuff. We didn't look at any financial data in today's episode, but we do behind the scenes. And it was FinChat. It's now rebranded in the last couple of weeks to Fiscal.ai, FISCAL.ai, which is still our favorite investing tool. The company's made incredible strides. They've got some really deeper ways they're integrating AI into the financial analytics that they give you, earnings calls, 10Ks, 10Qs, a whole bunch of data, their own custom analytics that they pull out by hand. We're big fans of Fiscal.ai. And if you go to Fiscal.ai/wildlife, you'll get a handsome 15% discount. So big fans, highly endorse that service if you're not using it today.
Fantastic. And if you're fans of our show, check us out at patreon.com/Wall Street Wildlife. Are you ready to be a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.